All right, let's welcome in Diane King Hall, host of Morning Movers. She has some movers for us. We'll start with On Holding. What's going on there this morning now?
People are still buying their shoes. I mean, we see them everywhere. A lot of the guys down here have them on their feet. They're still a leader when it comes to both direct to consumer and wholesale. They did well on both metrics. They beat expectations on both the top and bottom line in their most recent quarter. When you convert to dollars, they earn on an adjusted basis 23 cents a share. Street was looking for 16 cents a share. Revenue top 807 million. Well above estimates. The street was looking for a little more than what was looking closer to 571 million. So again, 807.7 million, far and away a beat when it comes to sales there. So they had strong sales growth. You're looking at year over year up more than 40%. There was momentum across the verticals, whether we're talking about direct to consumer, which jumped 45%. That made up about 38% of total sales. Wholesale sales also climbed. That rose more than 41%, Nicole. And you saw improved profitability across the board. Gross profit margin rose to nearly 60%. That is up actually just a little bit on a year-over-year basis for gross profit margin. The adjusted EBITDA margin also expanded. That expanded to 16.5%. So that just shows improved efficiency here. Net income margin, that was 7.8%. So they're really just firing on all cylinders, Nicole. They boosted their full year outlook, 2025 net sales guidance. They're guiding for at least 28% growth. They're forecasting gross profit margin to come in between 60 and 60.5%. They did acknowledge some uncertainty from global trade policy shifts, but they are still confident in their performance. In terms of catalysts for demand this most recent period, they had these new product launches, the Cloud Surfer 2 and the Cloud 6. That's a newer iteration of their, one of their popular lines, Nicole.
Yeah, and it's so important to have that innovation. I mean, every time I speak to a CEO, they always say, we always have to have new products. We always have to have something to get folks excited about, et cetera. I mean, On is down 28% and this year to date. Nike is down also year to date, down about 17%. So the group is still having a bit of a tough time, but great news to see this. And I'll tell you, when I saw the numbers in the after hours, it was up 8%. So it's not up 8% now, it's up 1.5%. But it certainly shows optimism there for On. Let's get to JD.com as we talk so much about China too, but the earnings.
Yeah, look, JD.com actually did better than expected in their most recent quarter. If you convert it to dollars from yen, adjusted EPS came in at $1.16 a share. Revenue topped $41 billion. Street was looking for $40.2 billion. So they beat despite just headwinds there. There are, kind of concerns about the consumer in China. They've had some weak consumer sentiment over there, and just the consumer has been struggling in China. We talked about that some time now, the economic drag that they've been having there. They've been dealing with some high unemployment, that property crisis that has just caused, kind of pain for their economic picture. Also at play with regard to JD is, to some degree overall affecting the economic picture, tariffs, but they're not as exposed, for instance, as say Alibaba or PDD, which is the parent company of Temu, for instance. JD has more focus on China. So again, they had an increase. Revenue was an increase of more than 15% on a year-over-year basis. They are relying on discounting, for instance, and government subsidies to just keep consumers spending. JD, they're a platform that consumers use it for appliances in particular, and there have been some government subsidies there to stimulate demand in China, again, because of that weaker economic picture. They've been offsetting that economic softness and the trade tensions as well. So you do see a recovery there and just kind of early signs of consumer rebound. But again, JD hasn't performed as well, for instance, as Alibaba or as, if you're looking at in terms of share performance, or as PDD this year compared to those.
Yeah. Meantime, it's up year to date, unlike a lot of stocks.
This is true.
You could take that. And then last but not least, we have Coinbase.
Yep.
Lots of pieces of news here.
Yeah, indeed. I mean, shares rallying well over 10% right now. This is off the news that Coinbase will be added to the S&P 500 as of Monday. It will be replacing Discover, and that's because Discover is being acquired by Capital One. So that's hence the movement there. And we'd seen some changes in the S&P 500 recently, but they're joining the S&P 500 on Monday. It's a big move. It's a milestone moment when you think about Coinbase and the progression of cryptocurrency and how much more, widening its acceptance is with regard to the financial system, just greater adoption. It shows just a more mainstream idea around crypto and its positioning now. Now, Coinbase hasn't performed as well year to date as Bitcoin, Nicole. I mean, Bitcoin has outperformed the S&P 500 year to date. I mean, although we've seen some recovery in the S&P 500, still not positive for the year, whereas Bitcoin has been up before today about 10%, whereas Coinbase has lost some ground. So it's decoupled from the performance of Bitcoin, whereas before they were more correlated. It's now been trading more like the altcoins. And when we talk about the altcoins, we're talking about Ethereum, Litecoin, XRP, etc. One analyst or expert I talked to recently said with Coinbase, his view is that Wall Street doesn't really know how to value it, and that's one of the challenges with it.
Yeah, that's interesting. I mean, I did see Moness has a $300 target, and what Oppenheimer was $293.
Yep.
But you're right. I mean, it's not doing as well as Bitcoin. It has sort of stepped away from that, but it is really the only representation really of crypto.
Yeah.
In the S&P 500,
yeah,
and that's a big deal.
It's true. It is a big deal. When you think about where we've come with regard to this, I mean, it's essentially like Bitcoin as a teenager. Think about when we first started hearing about Bitcoin down here. It's kind of like, what is that? 15 or so years ago. And to where we are now. Last year, you had those ETFs, for instance, like IBIT coming to market, showing increasing institutional acceptance, and you are seeing more institutional flows into, say, Bitcoin or Coinbase. One of the things that analysts say they do want to see more is more retail activity with regard to Coinbase. It being added to the S&P 500 obviously gives it more credence, because then those, say 401ks, et cetera, that have, an index that tracks the S&P 500 or S&P 500 index within there will then gain exposure to crypto through the addition of Coinbase there, Nicole.
Yeah, I saw potentially $16 billion of potential capital inflows for Coinbase because it's going into the S&P. As Diane's saying, these passive and active investment vehicles have to mimic this index exactly.
That's right.
So they have to buy Coinbase if they didn't have it, or buy more to get the values just right. Diane King Hall, great to see you. Thank you so much. You can catch her on Morning Movers every day here on Schwab Network.